Hey Justin, how you doing today?
Doing well. Good to be with you, Paul.
Good, good, good. So tell me about this new tax strategy that you've developed and you're helping out lots of business owners with.
Oh, sure. My firm, Elevated Tax Strategies, our goal is to help business owners, real estate investors explore, advanced tax saving strategies, the kinds of things that the ultra wealthy, big corporations are doing all day long, which is why we hear about big names not paying any taxes, and it's frustrating for business owners saying,
Mm.
"I'm paying so much," and helping make those accessible in a way that is within arm's reach of business owners. And so, business owners that are facing some kind of capital gains or liquidation event, like they're selling their business or selling a property or selling their property and a business together, they know capital gains is going to be a major impact, whatever the gain is, from what they initially invested. For a lot of business owners, they bootstrap their business. They start it from day one. They've got little to no basis in it. That's how much they've invested or what they've already paid tax on. So when they sell, it's virtually all gain.
Yeah,
Or if they acquired the business, they may have put some money into it to acquire it, but it's grown.
yeah,
And now they're looking to sell. And so what do you do about that? And so, one thing I want to acknowledge, the strategies we bring to the table are not new in the sense of we just created them. I find that when someone's pitching a tax strategy that is a secret
yeah,
or that is some new thing, maybe not 100% of the time, but maybe 99% of the time, just run the other way because when you're looking at advanced tax strategies that can really serve you well, you want to find something that's been around, that's built into the tax code, the actual statutes that have been created to give opportunities for business owners to take advantage of to continue to grow the economy, continue to grow business or build wealth or investments. And so there's actually opportunities that most business owners never have presented to them of what they can do to continue to let those funds that they've been, this wealth they've been building by growing their business. For a lot of small business owners, when they go to sell their business, like this is their most valuable asset. It's their business.
yeah.
And so now they're going to exit, which means they're going to, kind of convert that asset into cash. They got a buyer, and the problem is the government's going to come in, and if you're, no matter what state you got federal capital gains, which hits up to 20%, and a lot of states have capital gains as well. I'm located in Oregon, which is 9.9% capital gains, and um,
So they pay
California
capital gains at federal level and a state level, so
and
it's
state,
like
yeah,
double. So they could be
and a
paying
lot of time,
over 30%.
yeah, it could be 30% or more depending on what state you're in, and that's a huge hit. I was working with a couple sellers just recently together, two partners selling their business for $6 million. And they're looking at about a $1.8 million capital gains tax on that, which means what they worked really hard building this business over the last about 5 years for them to get it to a $6 million value. They found a buyer who sees the value and wanting to come up with the cash to pay for it, which is amazing. And now the proceeds go from 6 million to 4.2 just because of the capital gains tax. And that's a big hit.
That is a really big hit because you think about it, like a lot of times, like when I'm in negotiation with a buyer or seller, they're haggling over a couple $100,000 on the purchase price or the terms of the seller note. But really, they could focus on this strategy and sort of save that tax hit, right? Like $1.4 million, that's a lot of money, to be saving, right? Rather than, haggling over $200,000 of the purchase price for the buyer, correct?
Absolutely. And so when sellers consider, what might I do about that? First of all, often they look to their accountant, their CPA, their tax preparer, um, who's well versed in understanding tax returns, understanding taxation like capital gains and all of that. And the downside with that is tax preparers, their focus is on compliance, completing tax returns, which is an enormous undertaking and it requires great expertise and knowledge and experience to do that really well.
Mhm.
So even the great tax preparers, their skill set and their area of expertise and specialty is not tax strategies. And so that's where often going to your CPA is a bit of a dead end when it comes to finding some kind of proactive strategy to deal with that potential, that upcoming capital gains bill. that's coming. And so, but when, you haven't sold your business yet, and that's the time to start, considering what can I do? When they do, maybe do some searching on the internet or finding some videos on TikTok or YouTube and hear different strategies, a couple things often come up. One is a seller of a business can carry a note where I don't get cash up front. Maybe I get installments over the next 5 years or so for my business. Many sellers know there's risk to that because you're counting on your buyer to keep your business running and profitable all those years so they can service the note and pay you. That does spread out your capital gains bill gradually over those years, whatever the length of the term is of the note. So that is a way to slowly defer the capital gains bill. But at the end of the day, as you get those payments, you're still paying the same chunk to the government. So while it might spread it out a bit, which is beneficial, you really end up in the same place. And you're taking the risk of can this business actually, well, what if they run the business around in a couple of years and they actually can't continue paying on the note? Now you're in a big problem. A lot of sellers rather not do that if they don't have to.
Hmm.
Another that gets thrown out there is investing in qualified opportunity zones. So these are zones that the federal government has identified as disadvantages or low economic areas where they want people to invest in. And so they consider them opportunity zones. And so you can um, use the proceeds to like buy a property or in a business in an opportunity zone. Absolutely valid, wonderful thing to do. But there's a lot of misunderstanding about that. Actually, when you do that, you defer your capital gains bill. So, for example, the sellers I mentioned selling for $6 million, they're
Hmm.
facing $1.8 million capital gains. If they took that entire 6 million and put it into an opportunity zone and acquired let's say a property in an opportunity zone, then their capital gains bill would not be due right away. But the rules around opportunity zones are kind of phasing out. So it actually only defers your tax until December 31st, 2026. Well, that's about from where we are today, about 22 months.
Yeah,
That's not
a
a
lot
long
more.
time. So in other words, you're still going to have to pay that, for that example, that 1.8 million capital gains in less than 2 years. Um, and then
Seleno would be better at that point.
yeah, and then the beauty of an opportunity zone is that if you hold it for 10 years, which is a long time to be locked into a single investment, if you hold it for 10 years, when you go to sell it, the appreciation or the growth of value of that property is not subject to capital gains. And so that's a nice perk. But you're really there's rigid rules around that. You're stuck in one investment in one place. All your eggs are in one basket. And
Yeah,
a lot of sellers, that's not what they want.
yeah.
Only deferring for, a little over a year, and being locked in. And they don't realize there's actually some alternatives, some really great
What
alternatives.
about the 1031 exchange?
Oh, I'm glad you brought that up. So that's a great kind of example to use that kind of gets us into some of the alternatives for a lot of sellers I work with, just the right thing that meets their needs and helps them achieve their goals. 1031 exchange is a wonderful opportunity to take the proceeds from a sell and be able to reinvest that, deferring the capital gains, which means there's no bill due today. I'll kick that can down the road. And the savvy investor knows that I'd rather keep my money in my pocket today so I can continue to put it to work for me and pay the government later their tax. So 1031 lets you do that. But there's, again, rigid rules around it. One is it's a like kind exchange for real estate only. So I've had business owners ask me, is there a 1031 for my business sell? And it's like, actually, no, there isn't. 1031 is only limited to real estate transactions. Um, Also, the transfer from your proceeds from the sale of your real estate have to be into another real estate, another property. Um, so that's a rigid rule. Plus, there's time constraints. When you sell your property, you have 45 days to identify up to three properties that you want to acquire, and then 180 days to close on one of those three. If you don't meet those kind of markers along the way, then the 1031 is basically null and void, and you use a qualified intermediary, which is a 1031 company that effectively just holds your proceeds during that time period while you acquire another property. And if you can't meet those requirements, these funds get dispersed to you. The government calls that constructive receipt, means you have your hands on the money. You're going to be taxed now. So there's limitations there. Only real estate, only for the sell, only real estate for the purchase, and time limitations. People that are really involved in real estate have seen many cases where sellers have had what they call failed 1031s. They were trying to 1031, couldn't acquire the property. Somehow it fell through, weren't able to get another one in time, and now the tax bill came due. Plus, you're limited to just real estate. As you're working with people selling their businesses, that's not even an option. Now,
Yeah,
sometimes someone selling their business and a piece of property with it together,
yeah.
yes, they can use 1031 just for the property portion, not for the actual business sell. So it's a great option for some people when what they want is to go from real estate to real estate, and they really have it lined up to be able to do so in a timely manner.
So tell me about this secured structured sale. Who's it for? How does it work? And maybe who's it not for?
Got it. Okay, so as you name that, secured structure sales. So this is a strategy that allows a seller to, if whatever they sell their business for, using that $6 million example, I'm saying, um, that it's setting up a deferral structure that allows those funds to be captured in a tax deferred state for future investment. Unlike 1031 exchange, where you have limitations of like kind, it's got to be real estate to real estate. You also have time constraints. In this structure, you have no time constraints and no like kind requirements. So if you're selling a property or even a business, this structure can capture those proceeds in a tax deferred state and allows you to reinvest them in whatever you like. You actually get to appoint your financial advisor, your wealth manager, investment advisor, whoever that you rely on and you trust, to be able to work with you to invest. It can be invested in securities, stocks, mutual funds, T-bills, or invest in acquiring real estate or investing in a business or seed money for a future business venture. There's a wide variety of options, virtually unlimited reinvestment options. It's kind of like a seller telling the government, hey, even though I'm selling my business or I'm selling this property or both, I'm not cashing out yet. I continue want this money to work for me, and I'm going to continue to invest in growing the economy, invest in the markets, whatever that might be, and I'm going to pay tax as I choose to. So it really empowers the business owner as I decide to take disbursements from these funds personally that I can use for personal spending, then I'll pay the tax. And so a lot of times we structure this to be a 30-year tax deferral, which means these proceeds can be
Wow.
captured and reinvested and wealth built and grown for 30 years. And so when you take a capital gains bill, like the example I said, a $6 million sell with a 1.8 million capital gains bill that's coming, and you say, hey, let's pay that in 30 years, because this structure will be basically a term of 30 years that I can continue to use the full 6 million to build wealth, to grow my investments over that whole time period. And then in 30 years, that this dissolves and I can receive all the funds and this tax bill will come due. Well, because of inflation, the time value of money, um, that tax bill in today's dollar is often about 30% of what it was. So you're talking a 1.8 million that in today's dollars might be now worth about 600,000. That's a massive discount because of the benefits of inflation. But also, I just had 30 years to put that entire amount to work for me.
Yeah.
And what that can accomplish, whether it be in the markets or real estate or whatever you want to invest in, is really enormously beneficial.
So the 1.8 tax bill is sort of frozen in time. 30 years from now, they have to pay the 1.8. It doesn't grow, correct?
No, it does not grow with inflation because it's based on the original transaction.
And then
Um,
as you invest those proceeds, then there's additional taxes based on the growth of the 6 million, correct?
So the growth, the appreciation of that, yeah, that can have its own taxes, like any investment that you grow. As you take distributions from these funds, and you can at your leisure at different points along the way, they're not frozen and inaccessible to you. There's a lot of flexibility with this deferral structure. As you do, you pay taxes gradually. At If it's the growth, it comes to you in the form of interest income at ordinary income rates. If you take from the principal from your original business sale, it comes to you at capital gains. Um, but the idea is that you get to choose when you want the funds in your hands to be able to spend and
Yeah.
pay tax. And a lot of sellers that use this structure, they do that strategically, or maybe they take, little distributions out gradually year after year when they're in lower tax brackets. So they actually pay a reduced bill by leveraging the years where their income might be in a lower tax bracket, and so they actually end up over the life of this paying less tax than that original one point
Yeah. It's
because they're
like
taking
using that
advantage.
$1.8 million, the government's money to make money. It's kind of
Exactly. Which is, ultimately what the 1031 exchange, which a lot of people listening to this might be familiar with 1031 exchange. It's very well known. Um, the benefit of that is saying, hey, government, I want to keep investing in real estate. And I'm going to use that tax bill that I otherwise would have paid to continue to grow wealth and invest in real estate. And the government creates the rules that allows you to do that. And people sometimes ask, why would the government let you do these kinds of things? Well, the tax code is literally written to favor business owners and real estate developers and investors, because that's what drives the economy. That's what creates jobs. That's what builds cities. That's what moves the engine of our country
Mhm.
along. And so they need to incentivize that. So people continue to invest, continue to build, continue to grow businesses and create jobs.
Yeah.
So this structure is a phenomenal way to set that up. So we find that this particular one we're describing usually is a good fit when someone is selling for business somewhere around 2 to 3 million in value. That this
Does it
becomes a
matter
good
what
fit in the
kind of
way.
business it is?
Nope.
So just
The
two to
type
three
of
million is
business.
good.
Yeah, that's usually kind of the lower threshold, and we've seen it accomplished for 5, 10, 20, 30, and million and plus as a great strategy. What's also really great about really flexible, let's say someone is selling their business for $6 million and they say, "Hey, I would like to defer $5 million from my sell, and I want to receive 1 million. I'll pay the tax on the 1 million because I want to have that liquid in my hands. I want to remodel my house. My wife and I want to go on a beautiful vacation around the world. We've been grinding it out in this business for the last 20 years, and we want to enjoy ourselves a little bit. Whatever." You have the flexibility to say, okay, here's how much I want to defer and
Yeah,
put it in a structure.
that's
It's not an
great.
all or nothing. Um,
And what about if it's like if there's like multiple partners in a business and someone's got like a minority share, does it still work?
Absolutely. That's part of the beautiful flexibility is that each shareholder has the option if they want to use a structure like this to defer their portion of the gain. We've seen scenarios where you got 50-50 partners and one says, "Hey, I want to defer my tax and be able to leverage this money for the next 30 years," and they can see the beauty of how that can go for them. And another one says, "Hey, I have different plans for this. I'd rather not." That's absolutely fine. Or it could be a majority partner who uses the deferral structure and a minority partner who gets a much smaller piece of the proceeds, and that just gets dispersed to them, and they don't use the deferral structure. So there's flexibility. Each partner can
Yeah.
decide for themselves.
So when's the ideal time to start talking to you about this? Like when they start thinking about selling their business, or when they received an LOI, or when they engage a business broker? When should they
Yeah,
start?
that's a really good
How
question.
long does
So
it take to
I
set up?
would say, yeah, I would most often we are engaging sellers of businesses around the time they're getting an LOI. Uh,
Hmm.
However, what I find to be most ideal is when someone's starting to consider selling, we have some early conversations with them about capital gains planning, and that's part of what we offer complimentary. We'll meet with if anyone listening to this is considering selling their business, we would offer you a complimentary capital gains planning consultation to discuss your options. Okay, what kind of capital gains bill are you potentially facing, and what are some options of how you could address that? And so we recommend that very early on because the biggest part of the process is not the work that needs to be done to get this set up. Actually, this structure can be completely set up and dialed in a matter of gosh, well, we've seen it done in a week and a half when we're really moving quickly.
Wow.
The bulk of the process is education.
Hmm.
It's the conversations around how does the structure work? How does it set up in advance? Because it has to be established and set up prior to the close of sale, ideally before the purchase agreement is signed. Um, that's often the kind of the point of no return that the ball's now heavily moving towards closing and you're going to have constructive receipt. And this kind of needs to be established and the pieces put in place so that it's ready and staged to be able to receive the proceeds and defer the taxes for you. So we recommend. I'm working with a seller right now. He just listed his business for sale, I believe, last week, and we've been talking to him for the last about 2 or 3 months.
Hmm.
And it's been good because we've had a series of conversations, kicking this around. He's asking all the questions, really understanding not
Yeah.
just how this works, but how he's going to continue to work with it over the next, 10, 20, 30 years. And then also him bringing his advisors to the table to ask their questions, because sometimes a seller's CPA or attorney may not be familiar with this structure. And so they trust them, and that's where they often have a lot of relationships. So giving everybody that has a seat at the table time to consider this, to really understand the compliance and legalities of it. This particular structure has been put in place for successfully deferring taxes for the last about 25 years. It's been through 9 different audits, mostly the IRS and one with the California Franchise Tax Board. And the California FTB is by far the most brutal audit tax agency in the country. And all of them came back with zero changes and zero adjustments,
Great.
which is kind of the gold standard of an audit. It means we can't find anything that's out of compliance, anything that is in violation of the tax code. In other words, your deferral's legit. And that's beautiful. And we want to continue to maintain a perfect track record, our team that manages this structure.
Yeah, absolutely. Well, it's a big decision to make, right? It's
Yes.
a lot of money. It's a big decision that, you need to be talking to all your advisors and figuring out if this is the right thing you want to do. It does make sense, but it's just another option that, sellers can look at, if, and there's a lot of flexibility to it. So I really like that too.
Yeah.
Just wrapping up right now, running out of time. But Justin, thank you so much. You definitely have a wealth of knowledge and a lot of experience in this. So I'll put your contact information in the notes here. So if anyone wants to reach out to you, have that complimentary tax consultation, that's great. If they want to talk about this secured structured sale, they can do that too.
Yeah.
But yeah, once again, thank you, Justin. I appreciate your time.
You're welcome. It's a pleasure. Thanks for having me.
All right.